Tracking asset allocation across multiple accounts is a must. And I say that as someone who has been investing consistently for over a decade, and this habit has been a big part of my investing success over the years. And I created a handy spreadsheet to help me do this. Of course I did, because I create a spreadsheet for just about everything. And I'll show you my tracking spreadsheet in just a bit. But first, I want to explain the benefits of tracking your asset allocation, because there are several of them. So the first benefit of tracking your asset allocation across multiple accounts is that you get a bird's eye view of your entire portfolio. Because you don't want to look at just each account individually, you want to think of it as a whole. You want to think of your entire portfolio as one, even though it's spread across multiple accounts. A lot of investors fail to do this, and I think that's a mistake. Another benefit is that you stay diversified. So once you pick your asset allocation to begin with, you want to make sure it stays put more or less. You want to make sure you remain diversified. For example, if you decide you want your portfolio to be 50% stocks and 50% bonds, and that's the right level of diversification that makes you feel comfortable with your portfolio, then great. But you want to make sure it stays that way. So if stocks kind of take off and bonds do not, you don't end up with more of a 75% stock, 25% bond situation. You want to keep an eye on this and get your asset allocation back closer to what you originally intended. Another benefit is that you retain your desired risk level. You decide on a percentage of stocks, a percentage of bonds, and the reason you will have the bonds in the portfolio, maybe some cash in the portfolio, is that you want to control the level of risk that you're taking. You don't want your portfolio to be too volatile as the market goes through its ups and downs, especially its downs. So maintaining your asset allocation is important so that you retain your desired risk level. Again, the stocks, bonds, other asset classes can get out of whack and make your portfolio more or even less risky than you had in mind. Another benefit is that it helps you stay the course. So if you set up an asset allocation that you feel comfortable with, that you think you can stick with for the long term, which is really important, that's an important part of setting up your asset allocation to begin with, well, you want to make sure that your portfolio more or less maintains that allocation over the years and decades. Your asset allocation helps you stay the course, not panic during market downturns. And by tracking your asset allocation as a whole, it's going to be much easier to stay the course over time. Another benefit is that if you do need to make adjustments and rebalance your portfolio because your asset allocations have gotten out of whack, it's really easy to see this if you can look at all of your accounts as one portfolio, and you can make adjustments as needed in specific accounts to rebalance the entire portfolio. And related to this, when it's time to buy, you'll know what to buy. You'll know whether to put more money into US stocks, international stocks, cash, based on your asset allocation. You'll be able to see that, oh, maybe you're a little light on stocks right now because the market's gone down. So the next time you have some money to invest, you're going to put more of that into stocks to get to rebalance your portfolio kind of as you go. As you make purchases and build your portfolio, you kind of rebalance as you buy. And the flip side of that is when it's time to sell. If you're in a decumulation phase of investing, or you're in retirement, for whatever reason you're drawing down on your portfolio, just like when you're buying, you knew what to buy, you'll know what to sell. So if stocks have had a great run and that percentage has gone a little higher than what you wanted, sell some of the stocks. On the other hand, if stocks are down and bonds are up, maybe it's time to sell some bonds instead. All right, now that we know the benefits of tracking your asset allocation, I'd like to demonstrate this tracking spreadsheet that I created, and you can see how this works in practice. All right, here we have a copy of my asset allocation tracking spreadsheet, and I've put in some dummy data in here just so we can take a look at this and see how it works. And in the first column, column A, we've got a list of investment accounts. And then for each of these accounts, we have a column for asset class. And I've got 4 asset classes because these are the ones that I invest in and track. I've got US stocks, international stocks, bonds, and cash. And then for each of these asset classes, we have a value. So in this example, we've got $100,000 in US stocks in this account and $50,000 in cash. And then it shows you the asset allocation for each of these within this account. 67% is in US stocks, 33% in cash. And the total amount for this account, $150,000. And the portfolio percentage, in this case, this Roth IRA, is 19% of the entire portfolio. Now we can change these numbers. So for example, instead of $50,000 cash, maybe we want to put that to work in this Roth IRA and we buy more stocks. Now we've got $150,000 US stocks. That's now 100% of the allocation, still $150,000 in the account, still 19% of the total portfolio. And we've got the same thing going on for all these other accounts as well. In this traditional IRA, we've got $25,000 bonds, no other assets here. So that's 100% of the allocation, $25,000 in the account, and 3% of the entire portfolio. And on for each of these accounts, it works the exact same way. Now, if we scroll down to the bottom of these accounts, I have this automatically adding up down here in this table. We've got our asset classes listed. The big three here are stocks, bonds, and cash. Then within stocks, we've got that further split out into US stocks and international stocks. The value tells me exactly how much I have in each asset class when you add up all my investment accounts above. So I've got $650,000 in stocks, $100,000 bonds, and $25,000 cash. Within this $650,000 stocks, $550,000 of that is US and $100,000 is international. And then I want to skip over to this target column. So this is the target asset allocation that I've decided on ahead of time. In this example, it's 80% stocks and 20% fixed income. The fixed income is split 15% bonds, 5% cash. The 80% of the stocks is further split into 20% international, 20% US stocks. So that breaks out to 64% US stocks, 16% international, 15% bonds, 5% cash. This allocation is my desired asset allocation. That's what I'm shooting for. It's my target. But the column right to the left of that allocation, this is what my actual allocation is based on all the numbers I put above for all these different investment accounts. My actual allocation in this example is 83.87% stocks, 12.9% bonds, 3.23% cash. And then in the last column, deviation, this shows me how much more or less of each asset class I have compared to my target asset allocation. Like in this case, I've got 4% more stocks than I wanted. I've got 2% less bonds, 2% less cash. So if I wanted to rebalance this portfolio, I should sell some stocks, buy more bonds, and then within my stocks, I should sell some US stocks and buy more international stocks so that all of these equals 0%. Let's actually simulate that and see if we can rebalance this portfolio a little bit better. If I go up to this traditional IRA account, I can see I've got a nice mix of US stocks, international, and bonds. I'm going to take these US stocks, sell them, and buy a mix of international stocks and bonds. So maybe $20,000 of that will go into buying some international stocks, and then the remaining $5,000 will buy some more bonds. All right, now let's see how that affects my overall asset allocation. It's definitely looking closer. I'm still a little heavy in stocks and a little heavy on US compared to international. So I'm going to look for a place to sell some more US stocks. Maybe right here in my 401k, I've got $150,000 of stocks. What if I sell just about 10,000 of those? So we'll change this to $140,000 US stocks, put $10,000 of that into cash. There. Now my deviation is much closer to what I want. It's not perfect. It's not zeros all the way down, but we're getting closer. And you can see how as you rebalance, or even as you buy or sell assets as you go along, you can get your allocation closer to your target. And then of course, underneath the values, we have the total value for all accounts, including stocks, bonds, and cash, in this case, $725,000. And then I also threw in here 4% rule. So it takes this total and says, all right, if this is how much you have, according to the 4% rule, how much could you safely spend each year? And then adjust for inflation from there. And right now that is at $29,000. Of course, if this portfolio value got up to $1 million, let's say, then this 4% rule number would jump up to $40,000. All right, so that's how my tracking sheet works to track asset allocation across multiple accounts. And another question that often comes up around asset allocation is, how often should you rebalance? Well, there's a couple of ways that you could do this. One is you could rebalance on a schedule, say quarterly or every year on your birthday. Some set cadence that you set ahead of time and stick with so that when you're rebalancing, you're not trying to time the market. You're not saying, "Ooh, this seems like an opportune time to rebalance," but rather, this is the time when I rebalance. This is what I've put on the calendar ahead of time. And this is the time that I said I was going to rebalance. And regardless of what's happened in the market over the past 6 months or year or quarter or whatever it is, it's time to sell this asset and buy this asset and rebalance the portfolio. Another way to do it is you could rebalance when your asset allocation gets out of whack by a certain percentage. So for example, if you're 80% stocks, 20% bonds, and maybe stocks have a really good run, and now you find that you're 85% stocks and 15% bonds, well, you could decide that that 5% is your cutoff. So when it gets 5% out of whack, you're going to rebalance, you're going to sell those stocks, buy more bonds to get back to 80-20. Now, I've found over the years that I've actually rarely ever had to rebalance only for the purpose of rebalancing. Buying strategically, buying the asset class that I was a little light in, over time, that's been enough for me. This, and along with some adjustments in my 401k and my 457, this is all I've really needed to stay generally balanced on my portfolio. I have not found it necessary very often at all to get into any of my accounts and sell one asset and buy another asset just for the purposes of rebalancing. But for those times that I do make an adjustment in one account for whatever reason, I can look at my tracker here and easily see how the change that I'm about to make will impact my entire portfolio. And that really helps me out to make sure that whatever change I'm making aligns with my desired asset allocation. Another question that might come up is, what about tax considerations? Well, I'm glad you asked, because I use the same sheet that I use to track my asset allocation to track my tax allocation as well. On the same sheet where I track my overall asset allocation, I can see exactly how much I have in taxable accounts, pre-tax accounts, Roth accounts, and HSA accounts, because these are basically the four buckets of types of taxation that you can have for your investments. So, I simply track when I update each individual account. It also updates this table down here and shows me the percentage I have in each of these types of accounts. And is this very actionable? Not really, but it's definitely just nice to know to get an overview of your tax diversification and get more tax diversified if needed. Because in retirement, it's really nice to have a mix of different types of accounts with different tax treatments so that you can strategically pull from one account type or the other to optimize your taxes. And be careful about rebalancing your portfolio if you're doing so in a taxable brokerage account. That can trigger taxes, capital gains, and you want to be mindful of the tax consequences. Now, a spreadsheet like this isn't the only way to track your asset allocation. Another way to do this is to use software or website services like Empower. I use Empower, empower.com. This does this for you if you import all your investment accounts into Empower. It pulls in all that information and it presents these really nice charts that you can look at and drill down and see exactly how much you have in each asset class. And if you're in funds that contain multiple asset classes, like if you're in a target date fund, it'll pull how much of that is in stocks, how much of it is in bonds or whatever. So when you're looking at your overall portfolio, you can see across all your accounts, across all your funds, how much you have invested in each asset class. And it gives you a lot of granularity. Maybe too much granularity, actually. I use Empower to track my spending and my overall net worth and things like that. So I have it, I'm using it anyway. But as far as just looking at my asset allocation, I prefer to use my tracker for that. And I should mention that if your portfolio is 100% US stocks, let's say, or 100% any single asset class, or if you're invested only in one balanced fund, like you're all in a specific target date fund or something like that, in these cases, you don't need to track your asset allocation at all because you don't have these different allocations spread across different funds and different accounts. You're keeping it really nice and simple. And if that's how you invest, I don't think there's anything wrong with that at all. If you're invested in a 401k, for example, that's your only investment account, it's probably more likely that you're only in one fund. And if that's the case, you don't have to mess with this whole tracking asset allocation thing at all. In fact, if you log into your 401k provider, they probably have some nice charts in there, some information about your current asset allocation, and you can just take a look at that right in your 401k account. But for those of us with different investments and different accounts all over the place, a tracker like this is very helpful. Essential, I would say. Now, I was thinking about making this tracker available to all of you just as kind of a template that you could work with, make it available through Google Sheets. But, it's not super flexible. Like, you'll be able to change the name of the assets and stuff like that. But if you have more accounts than I've put on the sheet, or if you have more asset classes that you want to track, you'd have to get in there and change it to suit your needs. But if you do think it would be helpful, if you'd like to get your hands on this tracking sheet, I'll share this out through Google Sheets in the video description. Otherwise, give this video a like. It really helps my channel. And check out this video next. Thanks for watching.